Applying for a card payment service provider. Part 4, Credit Risk Validation. Welcome back. In Part 3, we explained exposure, the financial risk a payment provider may carry when processing payments for a merchant. We covered how exposure can be created by processing volume, delivery timelines, refunds, chargebacks, disputes, fraud claims, and business failure. We also explained that underwriters calculate exposure and compare it against the merchant's financial strength, liquidity, working capital, and ability to meet customer and payment obligations. In simple terms, Part 3 explained the question every provider asks. If something goes wrong, what financial loss we, the providers, be exposed to? At CRAC Solutions by Waterfall Innovations Limited, we help merchants understand how banks, payment service providers, and acquirers assess risk. We support businesses with merchant application provider selection, payment operations, risk preparation, compliance planning, chargeback and fraud prevention, and payment infrastructure improvement. We also support financial service providers by helping improve onboarding journeys, risk controls, operational processes, customer experience, and compliance workflows. So, in this video, we are focusing on credit risk validation. Credit risk validation is one of the most important stages in the application process. It is also one of the main reasons merchants are delayed, restricted, or declined by banks and payment service providers. So, what is credit risk validation? In simple terms, credit risk validation is the process used by banks, payment service providers, and acquiring institutions to assess whether your business has the financial strength to meet its obligations. The provider wants to know, can your business cover refunds? Can your business cover chargebacks? Can your business survive operational delays? Can your business deliver what it sells? Can your business continue trading if sales reduce, costs increase, or customers dispute payments? And most importantly, if something goes wrong, will the provider be left carrying the loss? This is why the underwriting team does not only look at your website and application form. They also review the financial position of the business. This may include your latest financial statements, management accounts, bank statements, credit reports, company's house filings, outstanding debts, county court judgments, director history, previous company failures, cash position, working capital, liquidity, profitability, and trading history. For banking service providers, the focus is often on the wider relationship risk. They want to understand whether the business is financially stable, whether the account activity makes sense, whether the source of funds is legitimate, and whether the business could expose the bank to financial crime, unpaid obligations, reputational risk, or regulatory issues. For payment service providers, the focus is slightly different. A PSP or acquirer needs to understand the risk created by processing card payments. This includes the possibility of chargebacks, refunds, fraud claims, disputes, delivery failures, subscription cancellations, delayed services, insolvency, or customer claims after the merchant has already received settlement. This is important because card payments create a timing risk. The customer may pay today, the merchant may receive settlement in a few days, but the customer may still be able to dispute the transaction weeks or months later. If the merchant no longer has the funds, or if the business has failed, the PSP or acquirer may need to cover the loss. That is why providers validate credit risk before approving the merchant. The underwriter will usually compare your projected processing volume against your financial capacity. For example, if a business applies to process £1 million per month, but the latest accounts show very low turnover, limited cash reserves, and no trading history, the underwriter may ask, how will this business support that level of activity? What happens if refunds increase? What happens if chargebacks occur? What happens if delivery is delayed? What happens if the business cannot meet its obligations? If the answers are unclear, the provider may decline the application or apply risk controls. These controls may include rolling reserves, delayed settlement, volume limits, transaction limits, higher fees, additional monitoring, personal guarantees, security deposits, or requests for further financial evidence. This is where many businesses make a mistake. They believe that stating higher projected volumes will help them receive better pricing. But if the projected volume is not supported by the financial statements, bank activity, trading history, or business model, it can create a credit risk concern. In some cases, overstating volume can make the application weaker, not stronger. The provider may see the business as unrealistic, undercapitalized, or unable to support the financial exposure generated by the requested processing level. Credit risk validation is not only about whether the business is profitable, it is about whether the business has enough financial capacity to absorb stress. A business may be profitable on paper but still have poor liquidity. A business may have high sales but very low working capital. A business may be growing quickly but unable to support refunds, chargebacks, or delivery obligations. This is why underwriters look beyond headline turnover. They want to understand the quality of the revenue, the timing of delivery, the level of customer disputes, the refund policy, the chargeback history, the cash reserves, the balance sheet strength, and the level of financial support available to the business. For newly established businesses, credit risk validation is even more challenging. If there is no trading history, no filed accounts, and no processing history, the provider has less evidence to rely on. In these cases, the underwriter may look at the group affiliation, linked businesses, experience of the directors, shareholder funding, business plan, contracts, supplier arrangements, projected volumes, website readiness, fulfillment capability, and the financial strength of any connected companies or owners. But if the business cannot evidence how it will support the requested processing activity, the provider may still decline or apply controls. So, what should merchants do before applying? First, make sure your projected processing volumes are realistic and supported. Second, prepare your financial documents properly. Third, explain your business model clearly. Fourth, show how and when you deliver the product or service. Fifth, explain your refund and chargeback management process. Sixth, make sure your website, pricing, terms, and customer journey match what you state in the application. And finally, do not ignore weaknesses. If there are low reserves, limited trading history, previous losses, or director related issues, explain them clearly and provide context. A well explained weakness is often better than an unexplained red flag. At CRAC Solutions by Waterfall Innovations Limited, we help merchants understand how banks, PSPs, and acquirers validate credit risk. We help businesses prepare stronger applications, present financial information correctly, explain exposure, respond to underwriting questions, challenge incorrect assumptions, and reduce the risk of unnecessary declines, reserves, or restrictions. For financial service providers, we support better onboarding design, clearer risk assessments, improved underwriting workflows, stronger compliance documentation, and a better customer experience without weakening risk controls. The key message is simple. Credit risk validation is not just a financial check, it is the provider asking whether your business can support the risk created by the services you are applying for. Before you apply, understand your numbers, understand your exposure, and make sure your application reflects the real capacity of your business. CRAC Solutions helping merchants and financial service providers navigate payment acceptance, financial services, and growth with confidence. Thank you for watching and speak soon.